My name's Joey Pasqualetti. This is my Capstone Project for financial statements. I picked eBay as my company. I picked eBay because it's something I use a lot, both as a buyer and a seller. It's very similar to Amazon, which I use too. I want to just know more about their financial records and obviously whether they'd be a good investable company or not. Brief history of them. They were made in 1995. They actually went in the name AuctionWeb originally, not eBay. That was changed in 2002 to 2003. And they went public in 1998, which is a very important year for most tech companies. 1999 till 2003 was the dot-com crash, which a lot of tech companies ended up going under during. There was a huge decrease in venture capital, and not very many companies survived through it. A lot of them did through incorporating smaller companies and having something very unique about them, which eBay definitely had and did. It kept them afloat. And they also survived through multiple domestic and global recessions, gone on over almost the last decade and a half now. The reason why they're so unique, they charge service fees to independent sellers. Small sellers that wouldn't otherwise be able to advertise to such a large audience are able to sell stuff for fees way lower than what they'd normally be charged to try and sell their services or their products. And even though they're one of the largest marketing companies, retail companies, they actually have no self-contained inventory, which is very, very interesting in that field, specialty retail. They've purchased many companies, and they've also internally created some to help grow their services. A lot of smaller tech firms and development firms to make their marketplace better, and then PayPal for fees processing on it, and a couple other things just to pad that. One of the coolest things I found out was they most expensive item sold on eBay was a $168 million yacht. It's just kind of crazy what all you can sell on there. You can sell just about everything on eBay. I'm not going to go too much into the specific fees, but like I said earlier, their business model is to charge service fees to independent sellers, and it works for them. They are able to charge lower fees than most other traditional auction uh, avenues, even for larger competitors like the person that sold the yacht. And for smaller people trying to sell their product, they won't have to pay large distribution fees that are flat fees. They're unrealistic for them. Just small percentage fees so they can sell something that they normally wouldn't be able to for small businesses. Also, independent sellers like trying to sell yard sale items or items around the house, sell stuff to people across the world, which they wouldn't otherwise have access to. It's one of the reasons why eBay is very successful. Um, as I said earlier, the dot-com crash is one of the big turbulent moments. One of the big things about tech companies, online e-commerce websites, just about everything tech related or internet related in this period, there was this huge time of uncertainty because there was a lot of failing companies in this time. eBay used that period of time to pick up a couple to increase its online presence and led to this period of growth here from 2003 till about 2006. Um, then from 2007 until about 2014, we experienced a lot of different global and domestic recessions from a lot of different issues. Uh, the couple points to note here, 2008 to 2009 was this dropping period. They actually changed CEOs in that year. That would cause a lot of uncertainty in the market. And then from 2016 through 17, they actually spun PayPal off as its own independent company, which also caused uncertainty. One thing I wanted to note was during this period of time, the 2008 to 2011 recession period, this dip here, where they changed CEO, this dip here. Most of these are periods of uncertainty. Most people that are investing during these periods of uncertainty, they want more surefire things. That's why the market stagnates as they sell or there's just lots of uncertainty. Uh, but they increase pretty regularly from $2 to $4 a year during these upswing periods. And one big thing to note, you can't really see here because we're not there yet, it's in the future. Based on things in future slides, I feel like we're in another period of uncertainty. Important thing to note is after these periods of uncertainty, there are decent periods of time of growth, which is what you'd want to be looking at as an investor currently. Uh, all of this is important, but I just wanted to highlight a couple things. They had a 5 to 6% increase in sales revenue and a similar increase in gross profit annually, and their operating income increased from 2015 to 16, and it just went down slightly 2016 to 17. But the one piece of information that was really significant about this company was this provision for income tax here. But the big things that happened in 2016 was there was deferred income taxes and a couple other tax laws that allowed them to essentially gain this large tax benefit in the year 2016, which very dramatically changed net income here. And then in 2017, there was repayment of some deferred income taxes, and there was legislation December 22nd of 2017, the Tax Cut Jobs Act, that dramatically impacted eBay, causing a large tax burden, which is what this provision for income tax here shows. And this grossly understated their net income for the year. This is their net income, but if you look at this in comparison to their income before income tax or their operating income, it paints a much different picture of the company. The reason why I want to state this is the goal of the company: the sales revenue, gross profit, operating income. This is the goal of the company, which they seem to reasonably be succeeding in. The non-recurring items and the tax uncertainty is what caused this extreme change in net income, which is something I wanted to note because, as I said, it's not the goal of the business to make money or lose money on income taxes. It's to make money through its primary revenue source and to its operating activities. Moving on to the ratios, because of the net income effect that occurred, especially in comparison to industry, these ratios are not very comparable. Although on a 5-year timeline, they actually had 2 to 4 times the industry standard profitability for ROS and ROE. It was just these 2 years in particular were very odd in comparison to previous years. But 4 things that aren't very impacted by the net income change that I feel like are important to look at for these ratios were the gross margin ratio, gross profit margin ratio. They're above industry standard by 58% and very stable year to year here. They also, for the efficiency ratios, the asset turnover was very stable, but it was about a third of industry standard asset turnover, however. But I feel like the fact that they don't have an inventory makes this section slightly not as relevant in comparison to the other sections. Their liquidity ratio, they're almost 2 times the current industry standard, and they're above the 1.00 mark, which means they can pay off their current liabilities with their current assets, which is something that's very important. This was also pretty stable between the 2 years. For solvency was very mixed. It tells a very weird story. The most important thing that I gleaned from it was this debt ratio. From 2016, they were underneath industry standard and essentially working as normal. And then in the year 2017, partially to do with their expansion into global markets, most likely, and to cover the large tax burden that was placed on them at the end of 2017. I'm assuming they took out a large amount of long-term debt, which, if there's anything that I saw that was reasonably negative and impactful, this was the one thing that I saw that was the negative sign. They are above industry standard, which is not good for this particular ratio. So overall, over the 5-year period for this section, they actually are reasonably profitable. They actually showed 2 to 4 times profitability over the 5-year period at industry standard. In the current year, they are in a weaker position. And the efficiency ratio, they didn't see much change, and they're improving generally, but they're definitely below industry standard. Liquidity ratio, they're very liquid, more liquid than the industry standard, and in a very good position. Their solvency is I would say that the company is not very solvent, but I'd have to see more information over a longer period of time or for future periods to make a full assumption on that because of how much happened this last year. So moving on forward, should you invest in the company? I feel like right now would be a good time to. The main purpose of the business is to obviously stay in perpetuity and to increase sales revenue. It's the main function of the business, which they're increasing 5 to 6% annually. They're focusing on untapped global markets with the acquisition of a company earlier in this year called Geosis. It's a Chinese company. They're trying to focus on Indian and Chinese markets, which account for approximately a quarter or a third of the total population of Earth, which I think is a really good step in the right direction. Focusing on those marketplaces that are currently being opened up would be a positive thing for an investor. Uh, Even though that there was a large tax burden, they were able to cover that without impacting daily operations. Even though it was an increase in the debt ratio and long-term debt, they were able to. And I feel like this is a good sign for them because they show that they have the ability to cover a nearly $3 billion unexpected expense or burden on them. And with 23 years of historic stock increases after periods of uncertainty, I feel like with the increase in competition, primarily from Amazon and other e-commerce sites, along with the largely negative, approximately $1 billion negative net income that they served this year, I feel like they're definitely in a period of uncertainty, which they historically have increases afterwards. And then in comparison to other competitors, they have approximately 32. Their stock is worth 32 times less than Amazon, which is their closest competitor. And that means for every one share of Amazon, you could buy 32 shares of Google. So they have a 3,200% increased effect of increases in the market. So your money would make you more money if their company went up by similar rates. And based on these 5 points and everything else covered in the presentation, I think right now is a great time to invest in eBay as a company. And if you guys have any questions, I should have the links to the all the financial statements in the description of this video. And if you guys have any other questions you need answered, you can message me, email me. Thanks for your time, guys.